Welcome to Breaking Banks, the #1 global fintech radio show and podcast. I'm Brett King.
And I'm Jason Henrichs. Every week since 2013, we explore the personalities, startups, innovators, and industry players driving disruption in financial services.
From incumbents to unicorns, and from cutting-edge technology to the people using it to help create a more innovative, inclusive, and healthy financial future. I'm JP Nichols, and this is Breaking Banks.
Welcome to Breaking Banks. Really excited to have a guest, and actually in a turnabout is fair play. When I first moved to Chicago a decade ago, I was on Tom Sosnoff's podcast in his studio in the West Loop. He is a multi-time entrepreneur, created $2 billion fintech exits really around markets, and he's going back at it again after having successfully sold thinkorswim for $750 million and tastytrade for over $1 billion. He's now focused on actually a very interesting niche that plays on markets and data in this idea of transparency. And this is one that I find particularly interesting is, how do you actually value yourself? What is the fair value of a Jason Henrichs? And how do I assess that? How do others do it? He has a platform that's coming out in the very near future called Lossdog that I think you'll find really interesting because it takes the applications of markets, lots of data sources, and it allows you to really understand, what am I worth? What will change in my value to the markets based on several variables? A very interesting, if you don't know Tom or of Tom, let's just say he's a fun guest. Look forward to getting your feedback on this episode of Breaking Banks. Tom, as you can imagine, we get a lot of pitches, like way too many pitches, a lot of poor pitches. You know, you are an old-time podcaster, and, I still remember sitting down with you in Chicago, being on your podcast, previous company. And this, I'll be honest, I read the pitch and I'm like, this can't be the same Tom Sosnoff I know. Like, he's the trading-centric guy. And here we're talking about an entirely different business. And I would love to hear you're the consummate entrepreneur, your entrepreneurial journey. How have you gone from the trading world to what Lossdog is focused on now? And I'm really curious about what that insight was that brought you here.
Probably 44 years or so of doing the exact same thing got me to the point where I'm like, every once in a while, there's these, you have these like moments, these transformational moments in your life when you think, there's got to be more to life than just placing an iron condor in the SPX or talking about. I have been on the road talking trading for the last 25 years, basically every other weekend for 25 years, 500 different cities. I have been building, a couple of amazing trading platforms. And before that, I was a pit trader. So I've done nothing. I'm a literal one-trick pony for 44 years. Options and futures and derivatives, and retail and professional. And I have essentially done the same thing. And when we sold Tasty 4 years ago, I thought when the time came that I could actually, sell my stock and realize my, basically take some money off the table, I thought it was time for me to try to, mess up a different world. Different, there's a lot of universes out there, and I'm not good at like looking at 20 different universes. I want to just focus on one. And I thought there was a crazy part of me that feels like people are just undervalued. And I feel like there is, I feel like it's time for me to do something where we can help a lot of people. And worker fairness to me seemed to be an area that nobody's ever wanted to touch. The idea that, it's not an idea, just we have this belief that most people throughout their lifetime are underpaid and undercompensated because they don't know what they're worth. So until AI came around, I wasn't really sure how to tackle that. But now that we have an easy way, not easy, but an easier way to get all this historical data and figure out some, I love building quantitative stuff. I mean, I'm a statistical geek.
Yeah.
I'm a math geek. And so for the first time, I was able to build a database that will allow us to essentially tell people kind of what they're worth relative to everybody else. It's almost like a Zillow for individuals, that kind of thing. And I always felt like different apps about jobs were either too social or too poorly designed. Like, there's just nothing out there to me. Like LinkedIn is just, it always drove me crazy because the design is so bad, and it's just such a nightmare once you get inside of it. And I also I don't know how much that helps you. And I really wanted to, do something that could change the way, people when they go into a job interview, or people when they go to negotiate something, or people when they decide, what they want to do or where they want to live, they can actually get an accurate idea of what they're worth.
So what data are you inputting into the model?
Millions of resumes and hundreds of millions of government data points, historical job data.
Okay. And, working backwards, like I immediately, when I was reading, the background on Lossdog, started thinking through, like, as the employer, how would I start to use this, right? Because, like, we're always trying to come up with our ranges by thinking through, like, okay, what's the most applicable job description? Now let's go pretend we're looking for that job on, Glassdoor, LinkedIn, and others to build our own data set. And to your point, like the ranges so varied, and you kind of come down to kind of economics 101. You end up offering someone kind of what they're willing to take, right? Like
that's the craziest thing. There's so many stories, and I'm I would say in the last 25 years, between thinkorswim and Tasty, we probably hired at least 14 or 1,500 people, and maybe as many as 2,500. I don't even know how many people we've hired over the last 25 years. And a lot of times, our HR team, and I have one amazing example. I found this kid who I really liked, and he was kind of an AI data scientist, just out of his master's degree. And he came to me and he's like, I love trading, love the markets. I think I'll fit in perfect here. And we needed somebody just like him. And so I'm like, great, let's work it out. I go, we got an HR team here, they'll figure it out. And so I went to my HR team. I go, listen, I want to hire this kid, make it happen. And the HR team asked me, they go, well, what do you think we can get him for? And I'm like, well, that's kind of your job. I don't know, what. And they go, well, and so I figured that he was probably worth about $140,000, $150,000 a year right out of grad school. And so the HR team said to me, they go, see if you can get him for 60. And I'm like, get him for 60? I'm so sorry. I'm like, get him for 60? This he's going to be 120 to 200 at any other firm. Like, what do you mean get him for 60? And as soon as they said that, I'm like, I know right then that the concept behind Lossdog was going to work, because nobody knows. Like, imagine a small firm that hadn't hired 1,500 people or whatever it is. And so I'm sitting there and I'm just talking to my HR team. I'm like, how can you not know, like, at least a real range of what some kid with a master's degree in data science and AI is worth? And they're like,
kind of market, right? A burgeoning field.
Of course.
Right, where it's like,
But I'm not as concerned about employers, even though we did build an employee side to this. What we built at Lossdog this time is really a two-sided market around salaries. So, like, if I put all your information and put it into our platform, and whatever the more you tell me, the better our number is. And it's going to come up with a bid and an ask, essentially. And our target is to get you to go for that ask.
All right.
And the difference between what you currently make, or what your value is, and what that ask is the amount of money that you're leaving on the table over a lifetime. And for most people, it's like $2 or $3 million. And I don't know if I think everybody thinks they're undercompensated, but nobody has the bullets, to to negotiate that because they just don't have any context. Nobody has context. I want to give you context.
So data transparency, right? To actually, this is kind of, if you think about the efficiency, and by the way, for a guy who said he was getting out of trading, this really does come down to it is a lot like trading, both to the bid and the ask. But if you think about that market evolution from the pit trader to electronic trading and the visibility, data availability and visibility of what you can do.
Well, what's even crazier is that when you say, I am saying I want to get away from trading, but essentially what we did was on Lossdog for our model to figure everything out, we essentially backed into our own version of a Black-Scholes model for figuring out option prices. We created the same thing for figuring out. So it has everything to do, like we have all the same inputs, like, you have volatility and time and everything else built into it. So it's essentially our own version of a crazy Black-Scholes model that we, to figure out individual value. And it's super interesting in that regard.
Once you actually started crunching all of the data, are there any data that just surprised you how influential it was that you said, of all the inputs you could have to your, personal Black-Scholes, here are kind of the 4 or 5 that matter most in terms of driving the outcome?
There's a couple things that I found really interesting, and just in all the testing we've done, because the platform hasn't gone live yet. It goes live in a couple weeks. And there's a couple things that came out really interesting. One is that finance in Chicago is a good place to be. If you had to pick a city, and if you had to pick a city to be in the world of finance, Chicago's pretty much like the top of the food chain is as far as affordability and salaries go. It's a good city. So there's actually a multiplier, that bumps up a little bit in the world of finance in Chicago. What we also found that's super interesting is how good the numbers are. Like when you're building like a theoretical model for trading, what Citadel will use or some other high frequency firm, you always wonder, how can their models be so perfect? And they always are. That's why they make billions of dollars, but their models are great because everything's based on scale. Well, the nice thing about the job market is it's huge. And there's hundreds of millions of data points for us to take information up from. So we have the scale. So what ultimately ends up happening is our numbers are pretty damn good. We can get it down to hey, you're worth, $92,000 if you were, in Chicago, based on where you went to school, based on how many years you're working, you're worth $92,000. Your target should be 104. And that difference is 2.3 million over, 30 years. And just giving people that much information is incredibly helpful.
Wow. So really curious on this, because my wife and I have been having this conversation a lot with our college-age nieces, and and second cousins around the Thanksgiving table about the future of work and jobs and careers.
Yep.
Right. And most models are backwards looking, that you're applying to forward looking, applications. How does AI play into this? You're obviously using AI for what you're doing, but for some of these careers, aren't we going to see hey, historically, going to law school turns out to be a pretty good trade. Going forward, going to law school might not actually be such a good trade from AI. How do you reconcile kind of backwards looking to create a model versus a very rapidly evolving forward looking?
So that's an interesting question because I didn't want to actually tackle the job market because there's so many firms out there and the job market is so subjective. Like I don't know what impact AI is going to have. I personally, if you ask me, Tom, what's your opinion of AI on the job market? I would suggest, and on trading and everything else, I would suggest that the better the technology gets, the more opportunity there is. So I see AI as creating a ton more opportunity for the next generation in many ways. And that will change a lot of jobs and a lot of industries, but I see the technology improving everything. But that said, we're not focused on, hey, what is we are focused on what the best fit is for you. We're not focused on what the best fit may be sector-wise down the road. Like, I want to optimize you. Like, so Jason, I would say my goal with this technology is to optimize you. My goal is not to tell you, hey, this is the best, you should do this, you should do that. Like, I want to be able to tell you, hey, you know what? If you want to go back to med school, you're going to be worth $320,000 a year. If you want to go to law school, it's going to take you from 120 where you are now to 260. I want to be able to tell you I want to give you statistical context, quantitative numbers around what you could do with yourself if that's what motivates you, if that's where you want to go. I can tell you, hey, you know what? If you move to San Francisco, you can make $80,000 a year more, but it might cost you $100,000 more to live there. But I'm going to tell you, hey, if you move to Tulsa, Oklahoma, and you can find something, it's $60,000. You might make less, but it's cheaper to live. All these kind of things. I want to get all the subjective crap out of there. And I want to make this completely a quantitative thing where people go there and they go, oh, you know what? That's cool. I mean, now I know what the numbers are.
How granular can you get around the optimization to be able to say, Jason, if you were to get this certification or to do this other thing or go take an online class, can you actually get to that level with the levers to be pulled?
You can get close. Like we could say, if you decide to go to boot camp, to learn, to learn some, like you went to boot camp for Python, or you went to, or you got some kind of additional degree, or you got your Series 7 or your CTA, that kind of stuff. The answer is yes, that does make a difference. Where we start to fail as a piece of technology is when you get up to a level in salary that becomes really objective or really subjective, meaning that from $50,000 a year to $300,000 a year, we built a killer piece of technology. From $300,000 a year to some CEO salary, it could be, we could be off by $1 million. There's no, what we found is a really interesting statistic. And this is, I did a lot of work on this myself because I just wanted to know. Most CEOs, especially if you're a Fortune 500, S&P 500 company CEO, the chances that you're overpaid, you're usually overpaid anywhere between, let's call it 35 and 50% based on everything that I've been able to figure out. And the average CEO works at a S&P 500 company for about 7 years. And the average salary is it's almost $21 million a year. It's an insane number.
Okay. Yep.
And so the average CEO, when you start to look at that, is probably overpaid by something like $40 or $50 million over the course of their career. The average employee, though, is underpaid by a couple of $1 million. And so what I'm doing is going after the individual employee just to give them, to make that the ratio between what they make and what the CEO makes or what executives make is absolutely freaking ridiculous. And we always had a rule. Scott and I always had a rule at Tasty. Scott and Christy too. We always had a rule at Tasty. We always had a rule at thinkorswim. We were never going to pay ourselves more than 4 times what the lowest paid employee was for us. So if the lowest paid employee was $60,000, we were never going to pay ourselves more than $240,000. That was our max. And we did that because we wanted to we thought it was an important message to send to everybody. Now, it doesn't mean what you can make equity-wise. It just means that was, on a salary basis. There are companies in America today where the CEOs make 500, 600. I think the highest one we saw was like 700 times what the lowest employee makes. It's insane. It's insane. You've been around a lot of CEOs. I've been around a lot of CEOs. 99% of them suck.
Yeah.
They just suck. They're no better than anybody else. They're not that much smarter. They're not worth 700 times, period.
Yeah. It's really interesting to think through that, right? Because there's a different market dynamic that begins to take over. And it really is, so much of this is like financial markets,
Yeah.
right? Where when you do get up to that C-suite, and as you're saying this, it's beginning to make sense, right? Where, of course, those people tend to overvalue themselves. And the bid ask, right? Like there's this external force that's pushing it higher and higher because you have to get someone into that job who overvalues themselves. And so I think, the tendency is probably you're like, well, I'll hire Jason for a while, but if he doesn't perform, he's out of there. Related to that, but I'm not going to land him. He's not going to look at the data and go like, oh, now you show me the data. You're absolutely correct. I am way overvalued.
Well, the problem is if you found the greatest young CEO, right? You find just a killer and you pay him $1 million a year. The perception is that you're a bunch of cheap bastards because he must suck because you're paying him so little. And the perception is that if you pay somebody $40 million a year, they must be great. And it's ridiculous.
It's a signal. Yeah. No,
absolutely. It's absolutely ridiculous. I mean, you see it all the time in sports, like these coaches and managers and everything else. There's a lot of good, especially here in Chicago. We're very happy that we hired Ben Johnson this year and paid him $13 million a year. Okay, yep. Awesome trade. But we also have a bunch of coaches on the payroll still that we're paying $10 million a year that no longer work here because they stunk. My whole point is just that there's a certain level that salaries are based on perception, not skill.
Yep. Makes a ton of sense. Well, I mean, let's talk about one of the biggest perception issues is the gender pay gap continues to persist, even with visibility brought onto it, right? In 2024, second year in a row, it actually increased. Right? For all of the scrutiny around it, it actually is getting worse that women make 85 cents on the dollar compared to their male counterparts in the U.S. What are you seeing in the data related to that?
Well, there's a couple things. I mean, first of all, unfortunately, under the current administration, they don't care about that. Like that's not on their short list that they're worrying about. The other issue with that is that there has always been when what drives salaries higher is things like data science and AI. You are always going to have a certain skew towards men. It's just a preferred, curriculum that it tends to be skewed. I mean, it's very hard to find, and those are the high paying jobs. It's very hard to find women who are physicists, who are data scientists, who want to be, AI coders and AI developers. It's just hard to find. Believe me, we all look for it. We need so much more diversity than we have, and it's just hard to find. And we struggle when we're hiring. We struggle with it. Every firm does.
And why do you think that gap exists? I'll call that an input problem, right? Like finding highly skilled, female physicists.
The gap exists because nobody knows what they're worth. That's what we are. That's what we're building here. I want to build this so that any woman or any guy, whatever, it doesn't matter who it is, when they go in for that job interview and they know they're qualified and they get offered, they're going to be like, listen, you know what? Industry says this job's worth $162,000 a year. Why are you offering me $132,000? But until you have that context, most people right now, they'll go into a job interview, and if they're offered the job because it's a very competitive marketplace, they'll be like, all right, I'll take it. That's it. There's not, I'll take it. And so employers, they go wherever the leverage is. And right now the leverage is on the side of the employer. A couple of years ago, the leverage was on the side of the worker. And so that's very cyclical. Right now, it's an employer's market. In a couple of years from now, it'll probably be, an employee market. But right now, the leverage is with the employers.
Yeah. Are you finding, this is just anecdotal, and I'm curious what the data say to this story, but it feels like whether we're talking about, the startup ecosystem in terms of valuations of private companies and because there's a similar dynamic, right? Does the VC have the power versus the startup around this? That in that world, where obviously I spend a huge amount of my time, the swings are becoming wider. Right. And over time, you normally expect efficient markets. The bid ask becomes more efficient and it narrows. In this ecosystem of, employer versus employee having, more relative power, is that swing becoming faster? Like, is it changing? Is it a bigger swing? What are the data showing you?
Are you talking about the employer-employee, or are you talking about valuations?
Valuations, right? Like, as you look at how valuations fluctuate.
So anytime that the last 2 years, because of what's happened, in the tech scene, specifically the AI scene, what's happened in the last couple of years is they've thrown private company valuations insane. And so, people that have an idea now, they'll go out and try to raise money, and they'll try to raise money with a $10 or $20 million valuation with a safe agreement. They don't even have a company yet.
Yeah.
Like, they don't even have done anything. They've just said, I got an idea. And they start talking to people and they're like, what do you think about this? And I'm like, do you have anything? And they're like, no. But I go, well, how do you have a valuation of $20 million? I had a guy pitch me. So we get pitched nonstop because I have my own family office. I invest in a lot of small companies because I really enjoy doing that. I don't make any money on it. I just enjoy it. I think it's
a hobby
hobby. I got to give back. It's really important to me to invest in lots of small companies. So because people took shots with me, so I feel like I need to take shots with other people. But I got pitched last week on a company that had no revenue, 6 employees, and they were raising money on a $140 million valuation. And I'm like, I'm like, where do you get this number? And they're like, because I thought he was going to say 10. So I thought that a $10 million valuation would have been fair for this company. He said $140 million.
Did you laugh, fall out of the chair?
Well, I like to encourage young entrepreneurs because those are the people I love. And so I would never laugh, but I'm like, dude, like, you're a smart guy. Okay. Yeah. Where do you get these numbers? And he's like, well, that's what somebody told me. They thought, we could raise money. And I'm like, well, I don't know who you're talking to, but if you would ask me what, after your pitch, I would have guessed $10 million. He goes, oh, that's a problem. He goes, that's a problem. And I'm like, yeah, that's a problem. Because, I don't get it. I think part of it's just, all of a sudden, like you said, these valuations are so insane right now that people think that their ideas are worth something.
Yeah.
Ideas have no value. And, it's all about the people behind the ideas. It's all about, what... I mean, listen, I love building something. That's why at this point in my life, I'm building something new because I can't sit still and I can't go away. Like, I have to. My wife's like, what the is wrong with you? Like, why are you doing this all over again? And I go, because I love 20-person companies where I can sit there from 7 a.m. till 7 p.m, just figuring out what we're going to do. It's the coolest thing in the world. I love it.
I love that. Well, some of the insane valuations we see right now all orient around the insanity related to stable coins. I know you have to have an opinion related to stable coins. I would love to hear, what are you thinking? Hype versus reality.
Okay. So Lossdog is as I've explained to you, we're going to be focused on individuals and worker inequity and all that kind of stuff. but I'm not that interested in a long-term subscription model. That would be our revenue model. I am really interested in building a digital ecosystem around workers, because on the one side, I think people need to know what they're worth, but on the other side, you have to have some equity investments in order to realize and recognize wealth over time. So I want to build a digital ecosystem. In the digital ecosystem, we will give people I'm going to give away $10 million in crypto when we launch Lossdog. When the software goes out in a couple of weeks, we're going to give away $10 million. So we're going to seed our base.
Okay.
But I'm also going to launch a stablecoin because I want people to understand how digital assets work, but I don't necessarily, before they start taking risk in a digital world, I want them to understand how digital assets work. My challenge with stablecoins is if you live in the US, there is not much you can do with a stablecoin. I mean, I don't even know, like if somebody said to me, "Hey, what are you going to do with this stablecoin?" I'm like, there's not a lot you can do with it. I mean, obviously you can fund it. You have access to your money 24/7, and you can fund something. And I mean, I mean, there's probably a list. I can go to AI and they'll give me a list of like 15 different things that are positive about a stablecoin. But what I found is the concept of stablecoin rewards, meaning they're very similar to just a certain interest rate. But what it does is in a tokenized world, it's an introduction to tokens. It's an introduction to a reward system. And on top of all that, okay, I think it opens up the door down the road to doing tokenized investments, which I do think have a future. I do think you're going to see us move from a listed world in one country, one listed exchange, all that kind of stuff, to a global marketplace that is truly tokenized. And I do think that stablecoins will be the vehicle that you have to fund with. Like we're doing a crypto giveaway, but for our own company, we're funding that crypto giveaway with stablecoins, with USDC. We're launching our own stablecoin though, which is something different. But we're funding our crypto giveaway with stablecoins because it's easier for us from a funding standpoint to be able to do that. Our customers will never know, but that's just how, that's one of the applications over time. It's just the instantaneous funding and a decent reward system. And then, and the only other thing that you can do with stablecoins is there'll be a way to eventually you'll be able to stake the stable coins and there'll be a different kind of reward. Like there'll be a little bit more upside than a traditional interest rates. If interest rates go lower, stable coins become more interesting.
Well, I was thinking when you started with the stable coin, where we're going to end up is you're actually going to do like the stable coin equivalent of taking the income share agreement on people's value. Like that would be interesting. I'm sick of hearing cross-border payments as the stable coin.
Forget that. I would never use the term cross-border payments. I don't know explain more of what you mean.
Oh, this is what we hear from banks all the time. It's like, we need stable coins to make Forex and cross-border payments.
Oh, no. I'm saying what you mean about people's value, what you said about people's value.
I mean, it'd be interesting, right, if I could tokenize Tom Sosnoff's value and, I think your value is going to go up and be accretive over time. And I want to buy a couple, Tom tokens.
Well, that's kind of fun. And there are some sites out there that have that kind of, they've tied it to like art, to people's artistic talents and things like that.
Yeah.
But I was just on one of those sites the other day looking at that. The challenge with that, and they've tried that, in sports, and they've tried that in sports before. You can buy, this athlete's future or this thing. And they've always, they've done it in other sports through sponsorships, over the years. And I think they've tried it with, other things like, they've definitely tried it with artwork and different, they've also tried it in, with actors and actresses and that kind of stuff. But individuals, that gets to be, it's very hard to clear that trade. Like, that's an easy concept, but it's not an easy concept to clear, meaning it's more of it would be more of like a peer-to-peer thing, and it'd be very difficult to collect on and that kind of stuff. I think the future of stablecoins, and I could be totally wrong, but I think the future of stablecoins as an alternative currency is really to have easy access to things that you want to trade or invest in that have been tokenized. Now, right now, that universe of tokenized assets is minuscule. It's minuscule, but it is going to get significantly better. And what it does is it eliminates currency risk and it eliminates clearing. And so, if you want to trade some equity somewhere in the world, if you want to trade gold and silver, whatever, sometime or whatever, any digital asset or anything you want, anything that could be reasonably cleared, meaning you don't have to worry about the counterparty risk. I think that's a little bit about what the future is. And also, it can be for companies that have not yet gone public. So if you wanted to trade, like Robinhood was looking at doing this in Europe, because it's not totally set up yet in the US or totally legal in the US, but there are going to be companies that instead of deciding to raise money through private equity or venture, they're going to tokenize some of their shares and then sell it to, it's like an advanced version of crowdfunding.
Yeah.
And it makes sense to me too. I mean, I would rather give access to there's only I could be wrong about this, but I think there's less than in the US, there's less than like 3,700 public companies. I think it's 37 or 3,800 public companies in the US, but there's something like, I don't know, 25 or 35 million businesses. Like, it's an insane number of businesses. And there's only, 3,700 publicly traded. So, even as an investor, I would rather, I feel much more comfortable with a portfolio of tokenized investments. And how do you do those? Well, it's really simple, through stablecoin. And I think I know I'm early, but I think that's where we could be going.
So it raises a question for me, right? Because you just described capital markets are inefficient because the expense of both taking these things public.
Private capital markets, private.
Yes. Private capital markets are inefficient because the cost of moving from private to public is expensive. Both the underwriting from investment banking and the ongoing regulation related to it. And let's face it, like back to your point around clearing a trade is, without a good amount of trading volume, who's going to be buying, these, forget micro stocks. These are micro stocks for small businesses, right? Unless they are truly tokenized and can be traded much more efficiently.
Well, there's no liquidity. In a non-tokenized market, there's zero liquidity. Zero.
Exactly. Friends and family.
In a tokenized market, at least you could theoretically have liquidity.
Theoretically. And so it raises a bigger question, and this is off the Lossdog train, but you're one of my go-to people when thinking of trading worlds. It begs the question is, practically any asset can be tokenized, or as a word I was introduced to earlier this week, financialized, which I'm like, that is not a real word on the pitch. Nor do I think everything should be financialized. And I'm curious where you come out on this, because this goes very specifically, and I want to hear your thoughts on the predictive markets. And one of the CEOs of a predictive market saying, he foresees and wants a world where everything can be financialized, e.g. becomes a predictive market that people can, he would call it trade on. I think of it as betting on, but I'm curious your view of the predictive market world.
Okay, so this is pretty personal to me, because in 2017, I decided I wanted to build a futures exchange because I believed that A, we needed smaller listed futures, and B, in the future, there was going to be this event-based marketplace, predictive marketplace. In fact, there's a company out there called Predict It, which I don't know if you're familiar with them, but Predict It was probably the first prediction market. And I think I tried to buy that company 4 different times back in like 2015 to 2018 or 20. And the CEO, nice, great guy, we just couldn't come to an agreement because I believed in the future of predicted markets. Now they were illegal. They were legal in the U.S. with limitations because they were considered they were university based. So they were one of two. Predictit was one, and the University of Iowa had a prediction marketplace, and those were the only two legal betting places where you could do event-based betting. It's mostly political, but they had limits of like $500 or $800 per bet. When they started, when Kalshi started, I was really focused on that, Kalshi and Poly Markets, and we got our own exchange approval, and I made the mistake of not building a clearing exchange. And what I didn't realize was that having the exchange was cool, but nobody would clear my trades. So I needed an exchange to clear trades. I didn't want to go back and I didn't want to go back and build and go for the process of building a DCO, which is a clearing organization. So I sold the small exchange. We scalped. We built it for. We owned two exchanges, Nadex and the small exchange. We sold them for $250 million to crypto.com. And then I bought the small exchange back for $10 million 2 years later. And then we just sold it for $100 million. So I scalped exchanges because the stupid trader that I am, but I never launched my own exchange. But I spent a lot of time, talking to Tarek, who's the CEO of Kalshi, and I spent a lot of time with Shane, who's the CEO of Poly Markets, like a ton of time, from like the time he was 21 on, and just bullshitting, talking about markets, and watching these guys struggle their butts off. I mean, it was hard. They had no regulatory approval. They were fighting the CFTC, the SEC.
Yeah.
And I thought I was helping. I mean, I know I was helping a little because I was giving them as much advice as I can, but I am absolutely shocked what they've turned into. I never would have imagined that these would be, $5 and $10 billion businesses. Like a year ago, they didn't have a pot to piss in, and I can't believe what's happened. So I'm a little bit, I'm mad at myself for missing it because I believed it for anybody. So I'm a little mad at myself.
Well, as you've said, it all comes down to the execution. And on that execution front, as we wrap up here, if people want to follow the Lossdog story, get access, where can they learn more? What does it take to register and become a user of this data?
So right now we have a sign-up page at lossdog.com, LOSSDOG. And I know it sounds like a weird name, but I've done really well over the years with weird names. But I saw a poster once in the basement of a building that we were doing a show in, and it was a lost cat poster. And I loved it so much, I had to name the company Lossdog. But you can sign up at lossdog.com and get on our wait list. We're going to be launching in a couple of weeks. And we also have a live show that we do Monday, Tuesday, Wednesday. And it broadcasts at 6 o'clock at night, at 2 in the afternoon and 6 o'clock at night. And it's called One Lucky Dog. And you can watch that on X. You can watch it on YouTube. It's Scott and myself. And it's just, we talk about entrepreneurship and business, and when we launch our product, we'll start talking about our specific product. So we love giving back as much as we can. So you can sign up at lossdog.com, and you can watch our show at lossdog.com or or YouTube or X.
Well, we will definitely be having you back to have some discussions about what you learn along this and predictive markets again. But thanks for taking the time, Tom, to share your journey and the quest for value. And I love the story behind Lossdog. And you've done quite well with your crazy names. I remember meeting you for the first time in Chicago, and it's like, do you know Tom from Tastytrade? I'm like, is that a restaurant? But but
hey,
fantastic.
you know, it's so funny. The first we started out, I interviewed you, and now we've gone the other way. It's great.
Oh, it all comes full circle.
That's right. Never bite the hand that may one day feed you.
Fantastic.
That's it for another week of the world's #1 fintech podcast and radio show, Breaking Banks. This episode was produced by our US-based production team, including producer Elizabeth Severance, audio engineer Kevin Hersham. If you like this episode, don't forget to tweet it out or post it on your favorite social media, or leave us a 5-star review on iTunes, Google Podcasts, Facebook, or wherever it is that you listen to our show. Those actions help other people find our podcast, and in return, that helps us build an audience that can be supported by sponsorship so we can continue to provide you with our award-winning content every week. Thanks again for joining us. We'll see you on Breaking Banks next week.